Hello again, this is Steve Wise, and we're here to talk about binary options. Today, in our binary options trading tutorial, we're going to be talking about matching a binary put option with a long stock purchase. This information is being distributed on YouTube, so bear that in mind as you choose to distribute it or link to it or what have you. It's otherwise copyright 2010, binaryoptionbroker.com, all rights reserved. Okay, so let's get started. I've made a couple of slides and let's take a look at them and see what they have to say about trying to match a binary put with a long stock purchase. Let's first take a look at a naked binary option put and look at the payout structure and how that investment works. What we did was we took a $50 binary option put on, I think in this case we used Google stock as an example. It's not labeled here, but at the time this was Google stock trading at $577.50 a share. And what we did is, what would be the payout structure on a binary option put that had a spot price of $577.50 a share. And what you can see is that the payout on a 75% yield in the money binary put option pays out just a little under $90 when the strike price, the expiration price of Google stock closes at expiration below the strike price of $577.50. Likewise, the payout of the $50 binary option on Google stock is about, looks like about $8 or $9 in the case where it expires out of the money, meaning that the stock price has gone above $577.50 a share. This is kind of counterintuitive, but if you've ever thought about going short a stock or being short in the market, this is kind of trying to take advantage, a cheap way of taking advantage of that. If you think the stock is going to go down, you would buy a binary put option, or you would just short the stock if you had the capital to do that. And if the price falls, you make money. If the price goes up, you lose money. So it's kind of the opposite of what a normal investment would be. It's maybe difficult for you to see them, but right at the point where the blue line meets the red line is the break-even point. That is what the payout would be on the binary option if it expired at the money. For example, if the contract was bought at $577.50 a share, and at the end of the day it expired at the stock finished the day at $577.50, that would be considered a push, and you would get your initial investment of $50 back. I just wanted to point that out. I'm not sure that I pointed that out in the last video, and I wanted to make sure to cover that here. What we intend to do with this binary option put, now I don't typically recommend buying just a naked option put, a naked put option like this, because of their high risk ratio. As you can see, you either get all or nothing in this type of trade. What I prefer to do is I prefer to use the binary option to work with another investment. And in this case, we're going to be talking about going long Google stock at the same time that we're going to buy this binary put option. And we'll talk about why I think you might do that. So just hang on a second. Let me bring up the other slide, and we'll get into that and into how that works and why that might be something you might want to do. Something that might be beneficial for you in your trading. All right? All right, so let's see if I can get the slide to come up here, and here it is. Okay, great. Now, what we've done here is we've combined a $3,000 investment in Google stock at $577.50 a share with $50 worth of a binary put option. Now, why on earth would you want to do that? Well, here's the thing. When you're going long in the stock market, typically what you're trying to do is you're trying to buy on the dips. You're trying to buy when the stock is at its low point. But that sort of market timing is practically impossible But if you see a value in the stock market and you want to enter the market for that security, in this case Google, you have to make a decision to go long the stock. You have to, at some point, you have to bite the bullet and say, okay, this is the best I figure the price is going to be, and then you jump in the market. Either you go with a market trade or you buy a limit, make a limit trade so that you get your price. When you do that, what you leave yourself open to, obviously, is that you miss the bottom of the market and that the price actually ends up going lower. Well, if that's the case, but you're certain that you want to own the security at the price that you see available, what you end up doing, what you can do, is you can go in the market, buy the stock at the price that you want. In this case, we used $577.50, and then immediately go into the market for binary options, buy a binary put option at the same spot price, $577.50. And what happens is, if the market closes the day or closes the top of the hour, depending on which contract you bought, you pick up a few extra dollars if the market closes below the share price where you entered the market long for the shares. And what you can see from the payout scenario that we've created, with just a $50, 1.6% of your investment, if you throw 1.6% of your investment in a binary put option that's paying out a 75% yield in the money and a 15% return of capital out of the money, this is what the payout structure looks like. If the stock price on that given day closes at expiration of your binary put option anywhere above $5.70 a share, even though the price of the share, the Google closes below where you actually bought the stock, you end up ahead of where you were on your initial investment. You actually come out above break even. So even though you entered the market at $577.50 a share, by buying this binary put option, you've given yourself the opportunity to actually make a few extra dollars, so long as your Google stock ends the day at or above $5.70 a share. The counter argument to that, or the counterpoint to that, is if it closes above $577.50 a share, then obviously the put option, the binary put option, expires out of the money and you only get a few dollars back. But the point is, you're getting, one way or another, you're getting what you want from this trade. At the end of the day, or at the end of the trading day, you own the shares of Google, which is what you wanted. And if the stock price went down, you put a few dollars in your pocket. If the stock price goes up, then Google's moving in the right direction. Your shares are going up, and perhaps you timed the market right. You actually bought at the bottom. And the point is, yeah, you're looking to lose a few dollars on the upside on the binary put option if the stock closes up for the day. But if you're buying a share of stock at a price in the market, you'd better hope, I would hope, that you're buying it with the expectation that it's going to rise more than the 1.6% that it's going to take to make over your break even in this case. I would hope that. Because if you're not, you should just stop trading altogether because you don't get it. That's really what I wanted to cover here. Just a quick demonstration of how you can combine a binary put option with a long stock purchase to try to capture some of the missed opportunity at buying at the bottom. Hey, we've had a lot of fun making this video. If you want to find out more information about binary options trading in general, or strategies, or binary options brokers, come visit the website binaryoptionbroker.com. I should remind you that all this information is copyright 2010 binaryoptionbroker.com. I'm Steve Wise, and I hope that all your trades end up in the money.